Thank you, Professor Benaroya. Let me know when you want to pause. What are strategic plans? Global companies call them strategic plans, the super secret documents you see stolen from executives in the movies. Banks lending to small businesses call them business plans. Regardless of the name, these are long-term plans designed to show investors how a company will achieve a turnaround or grow sales and net income. The definition of long-term depends on where you are. It's 5 to 10 years in Asia, 3 to 5 years in Europe, and 2 to 3 years in the US. While a summary of these plans is often shared publicly with investors, the detailed version remains confidential. Unlike the rigid 5-year plans of the former Soviet Union, good strategic plans have clear, achievable goals and explain exactly how they'll be accomplished. Sometimes referred to as business viability documents, these plans lay out why a product will sell at a profit or how a nonprofit will secure funding and users. Ultimately, they are holistic strategies, applying everything you've learned to map out a company's future.
One thing that I would like to add to them is a best practice that I saw at Procter & Gamble, where they use a document called OGSM. It defines what the objective is, but also quantifies and measures in a clear way. And one is supposed to write a clearly defined strategy on the execution or how to go about it. And that is something that I recommend everyone to always bear in mind.
This is the process for a great strategic plan and the 4 steps to consider.
It's about research, getting the historical financials, doing a forecast, and then deciding whether to buy or build your own company. And you need to try to spend as much time doing research as you will doing the PowerPoint or the marketing plan itself.
How to make a strategic plan? A good strategic plan encourages bold thinking. All ideas are welcome, but it is not just a daydreaming exercise. Through research, it quantifies how many units will be sold at what price and why consumers would choose the product over competitors. Costs and expenses are reasonably estimated, including investments like the cost of creating an app. Includes a low-cost test market to validate ideas. Can be clearly explained to both your aunt and an investment banker. A bad strategic plan is merely a daydreaming exercise. Is bold but unrealistic, proposing growth rates that have never been achieved. Lacks quantification of ideas and details on execution, including who will do what, when, and how. Contains untested cost and expense cuts that were arbitrarily made up on a laptop. Learn from others. Les Werner, the founder of L Brands, employed a strategy of copy and improve to build his retail empire. He closely studied successful retailers and brands, identifying their strengths and weaknesses, then adapted and improved upon their concepts to create more appealing offerings. For example, he transformed Victoria's Secret from a struggling business into a global leader in lingerie by adopting a more aspirational brand image.
And the key learning here is that whatever idea you may have, there is probably someone who has done exactly the same thing or something similar somewhere in the world, in any of the 193 countries. So doing a bit of research, trying to see what worked for them and what didn't is a real good way to make sure that you have a successful plan.
Now, let's break down the 3 steps to follow when making a good plan. Get organized and distribute the work. Assign tasks based on individual skills for greater productivity and motivation. For example, someone skilled at creating slides should handle that, while someone strong in finance should focus on financial tasks. Set clear deadlines. Researcher analyzes the company, competitors, and whether the proposed strategies have been implemented before. Spend as much time on market research as on designing your product or service. Learn from others' mistakes. Financial modeler reviews all strategies, quantifies their impact on net sales and net income, and ensures they align with the financial waterfall. Visual editor ensures slides have a strong visual impact and maintain consistency in fonts and style. Writer ensures titles on slides are relevant to the content and sentences are correct and concise. Coordinator ensures the team completes the deadlines on time and has a plan B when one team member doesn't. Responsible for submitting the checklist. See what other students have done. Search for George Benaroya Strategic Plan on LinkedIn to view numerous strategic plans published by my students. Leverage the speakers. Over 25 C-suite executives from the market-leading company in each industry have visited this class. Refer to the last 3 chapters for insights from senior executives at Fortune 500 companies on growing a business. Use their tips and include. The main sources of financing are your own savings, friends and family, either in the form of debt or equity, government guaranteed loans. These tend to have lower interest rates. Bank loans, equity investors, bank loans or equity investors. In Chapter 4, we explored the advantages and disadvantages of using bank loans versus equity investors. Let's see how this plays out for Maria, Jenny's sister. As Maria worked on her business plan, she faced a critical decision. Should she seek a bank loan or pitch her idea to equity investors? Each option came with its own set of trade-offs. A bank loan would allow her to retain full ownership of her business, but she'd have to shoulder the debt and meet strict repayment schedules. On the other hand, bringing in equity investors could mean sharing ownership and potentially losing some control over her decisions, but it would reduce her financial risk and provide her with strategic partners. Jenny shared with her sister the framework from Chapter 4, which helped her weigh these options. She created a pros and cons list tailored to her situation, factoring in her financial projections from Chapter 8. For her, the decision boiled down to control and independence. She felt passionate about maintaining full ownership of her vision, so she leaned toward applying for a bank loan. This kind of dilemma is not unique to Maria. It's one many entrepreneurs face when funding their businesses. Understanding the advantages and disadvantages of these financing methods is key to making an informed decision that aligns with both your business goals and your personal values. Own savings, friends, and family. Using your own savings or funds from friends and family is a common way to start a small business. According to the U.S. Small Business Administration, approximately 75% of small businesses use personal savings or borrow from friends and family during their early stages. Advantages. Personal savings avoids the need for external financing. It gives you more control and eliminates interest payments or equity dilution. Risks. Relying on savings comes with the risk of losing personal funds. Borrowing from friends and family carries emotional and relational risks, especially if the business doesn't succeed.
So that's one way to go about it. What we are going to see next is what happens if we get one of the government loan options that we have.
Equity investors. One is better off borrowing money instead of giving away equity if the business is successful. Let me illustrate with a story. Imagine you've just launched your dream business and things are starting to take off. An equity investor approaches you with an offer, $180,000 in exchange for 25% ownership. By doing the math, you realize the investor is valuing your company at $720,000 because $180,000 divided by 25% equals $720,000. It feels like a win now. You get the funding you need without taking on debt. Now fast forward, and your business grows beyond your wildest dreams. Scenario 1, your business grows to $1 million. That's great news, right? But here's the catch. The 25% you gave away for $180,000 is now worth $250,000. You've effectively lost $70,000 by taking equity instead of borrowing the money. Scenario 2, your business explodes to $10 million. That same 25% stake is now worth $2,500,000, which means you lost $2,320,000 by giving it away early. Scenario 3, your business becomes a massive success, growing to $100 million. That 25% stake is now worth $25 million, meaning you've missed out on $24,820,000. On the flip side, let's say the worst happens, the company fails. In that case, you don't owe a dime of the $180,000 because it wasn't your money to begin with. It was the investors. While you lose your business, at least you didn't take on debt or risk your personal finances. The takeaway? If your business is successful, borrowing money is usually the better option because you don't have to share future profits. If you think the business is risky or might fail, equity investors offer the advantage of shared risk. Advantages of getting an equity investor. Equity investors make it easier to attract more investors in the future, giving your business additional credibility. Just remember, try to limit the stake you give away to 1% to 3% whenever possible. Government guaranteed loans. In the U.S., the Small Business Administration, SBA, is a great source of financing. What is an SBA loan? SBA loans are backed by the SBA, a government agency, which lowers the interest rate cost. They are designed to help small businesses that might not qualify for traditional bank loans. Steps to get SBA loans. Eligibility criteria. Your business must be for profit and operating in the U.S. You do not need a green card to qualify. SBA loans are available to U.S. citizens and non-citizens, including lawful permanent residents, green card holders, and those with other visas. Business plan. Provide a detailed plan outlining your business model, target market, financial projections, and how you'll use the loan funds. Personal credit history. Lenders require a personal credit score higher than 640 to evaluate your creditworthiness. Collateral/down payment. Usually, you need to provide 5% to 10% of the loan amount upfront. Financial statements. Include income statements, Chapter 3, balance sheets, and cash flow statements, Chapter 4.
That's where we cover that.
Industry and business experience. Your experience in the industry and managing a business can be crucial factors. Loan purpose. Clearly state the loan's purpose and how it will benefit your business. Documentation. Be prepared to provide tax returns, legal documents, personal and business credit reports, and more. Tip. Compared to other countries, the SBA is straightforward about its requirements. The SBA won't lend money unless you are likely to succeed. They will check your financials, assets, and confirm the existence of the business you're acquiring. Warning: avoid paying upfront fees to consultants that promise to facilitate the loan. Always deal directly with SBA-approved banks. Maria, Jenny's sister, is buying Jenny's business. Jenny makes $32,400 per year with her shoe business. Her sales are $120,000, her cost of sales 30%, her expenses 43%, and her net income 27% of $120,000 or $32,400. Upon graduation, she was offered to start working at a top cosmetic firm making $115,000 per year. Her sister, Maria, agreed to buy Jenny's business at a low multiple, 3.3x net income or $100,000. She was preparing to get a loan from the Small Business Administration, but Jenny offered to sell her the business with a 5-year interest-free loan. Maria wants to be conservative. Therefore, her projections assume no growth. Her numbers are, in real terms, adjusted for inflation. How to do a pro forma P&L, BS, and cash flow. How to do a pro forma P&L. Focus on the 3 P&L ratios: sales minus cost of sales, minus all other expenses. The result is net income. How to do a pro forma BS. Focus on the 5 BS ratios: receivables, inventory, fixed assets, payables, and debt. How to do a pro forma cash flow. For the P&L impact on cash flow, strive that you will make money, have a positive income on an ongoing basis. Reduce expenses to achieve that. Remember this principle: first we make money and then we spend it. If your net income is negative, think about how you will finance that, debt or investors. Jenny's and Maria's cash flow statements. See also Chapter 4 for details on how to make a cash flow statement. Jenny pays no rent or income tax and keeps no inventory, receivables, or payables. She makes $32,400 per year, which she keeps in cash. After 5 years, she has collected $162,000. This is her cash flow statement for the past 5 years. Maria, her sister, is buying the business from Jenny for $100,000. Like in my family, in Jenny's family, siblings don't charge interest to each other. On her balance sheet, we see that cash is $12,400 instead of $32,400. The difference of $20,000 is the loan repaid to Jenny over 5 years. This is Maria's cash flow. Let's consider now what would happen if Maria borrowed from a bank. Her interest charges will be 10% per year, and she will be able to deduct it from taxes, but she will need to pay 20% income tax. This is what her cash flow will look like. With this simple example, I wanted to illustrate how the cash flow for the first 5 years, with the same exact performance, is reduced from $162,000 to $62,000, or $4,100 once we add loan repayment, interest, and taxes. Jenny's and Maria's cash flow statements. See also Chapter 4 for details on how to make a cash flow statement. Jenny pays no rent or income tax and keeps no inventory, receivables, or payables. She makes $32,400 per year, which she keeps in cash. After 5 years, she has collected $162,000. This is her cash flow statement for the past 5 years. Maria, her sister, is buying the business from Jenny for $100,000. Like in my family, in Jenny's family, siblings don't charge interest to each other. On her balance sheet, we see that cash is $12,400 instead of $32,400. The difference of $20,000 is the loan repaid to Jenny over 5 years. This is Maria's cash flow. Let's consider now what would happen if Maria borrowed from a bank. Her interest charges will be 10% per year, and she will be able to deduct it from taxes, but she will need to pay 20% income tax. This is what her cash flow will look like. With this simple example, I wanted to illustrate how the cash flow for the first 5 years, with the same exact performance, is reduced from $162,000 to $62,000, or $4,100 once we add loan repayment, interest, and taxes. A real cash flow problem was solved by one student of this class. When one of my students first encountered the cash flow crisis faced by impulse recycling in Nigeria, she knew the challenge went beyond numbers. It was about trust and visibility. The company, which provided a livelihood to 100 families, desperately needed $4,500 to scale its operations, but lacked credibility to secure funding. Her first step was to build a professional website that documented every aspect of their work with real photos and detailed explanations of the process. She explained how the women collecting bottles were paid upfront, $1 a day, because they needed cash to feed their families. Over the next 3 weeks, $2,000 went toward fuel and recycling, $500 for transportation to deliver the bottles to a facility, and finally, after 21 days, the company received $5,500 in revenue. To bridge the gap, she offered 3 options to potential supporters: a 10% interest loan, a 15% equity investment, or small donations of $5 or $10 to make a difference. By blending these approaches and emphasizing the company's impact on job creation, my student not only solved the cash flow problem, but also ensured impulse recycling could scale and transform more lives. How much to pay for a business? Multiple of net income. Buy for a multiple of 3.5x net income and sell for a multiple of 7x times net income. When buying a business, you shouldn't pay more than it would cost to do it yourself. For example, to get a business generating a net income of $100,000, you must invest $350,000 in operational losses in the first few months/years, fixed assets, receivables, and inventories. Then, to buy it from someone else, don't pay more than $350,000, a 3.5x multiple. When selling a business, your price should reflect all the pain and suffering, including long hours and the fact that it is successful. Target to get a multiple higher than 7x net income. Why acquisitions fail? The buyer assumes that he is smarter than the seller, will be able to grow sales and net income, and values the business based on that. The buyer assumes he can lower costs or expenses and values the business based on that. To find out whether a public company has overpaid acquisitions, Google name of the company, followed by goodwill write-down, or goodwill write-off, or go to the balance sheet, PDF statement, and do Control F and write down or write off. Learn about General Electric's write-down of $22 billion and more on the topic in this Wall Street Journal article. Mergers and acquisitions can rapidly grow sales, but success depends on their implementation. The goal isn't just to buy another company, it's to find synergies that drive growth. For example, acquiring a firm with a strong distribution network can expand your market reach, or a company with a loyal customer base can help scale your sales quickly. However, before pursuing an acquisition, it's crucial to use the net present value, NPV, formula to evaluate the financial viability. Additionally, unless your company has at least 50% of the purchase price in cash, don't assume the increased sales will translate directly to your profit and loss statement. The costs of financing and integration can offset short-term gains, so careful planning is essential.